Vinit Sambre joins us now, Head of Equities with DSP Mutual Fund. Let's understand where he makes the market is headed, and will it get bad, will it get terrible, and will it get horrible before it gets better? Vinit, what is the better word? Will bad get worse before it gets better, or bad has already got worse, now it's time to get better? I'm asking
Good
you to
morning.
play English. Fund managers normally talk valuations. I'm telling you to choose your English words very carefully today.
Okay. Okay. Good morning, viewers and Nikunj and the team. I think from a point where we were in terms of the valuations, let's say a few months ago, to now, I think a lot of that froth has sort of got erased from the market. That is the number one point. In terms of the price points for a lot of the sectors, I can say, there is much more margin of safety today in terms of the valuations. If one is really taking a 3 to 5 years view, I don't want to hazard a guess as to how the next 6 months are going to be, because there is so much of news flow, there is so much of noise. While most of the negatives are known today, inflation is hurting, interest rates are going to go up. Everyone is talking about it. So I would rather imagine that those news flows should incrementally not cause as much as of panic as what we see now. But it's more to do with the sentiments, because so much of money has changed the asset class. The flow of money may lead to some bit of panic and can cause more volatility, let's say, over the next 6 months. But I'm of a view that long-term investor has to really look at the valuations. They have to respect the valuations, and at a point today, I think with this correction, there is a good amount of margin of safety across a few sectors. There are sectors like IT where the valuations have come off to pre-COVID levels, at least within the large cap IT pack. So probably another 3 or 4% correction, and we get to a good valuation zone for them. And my sense is that they are not as badly impacted as some of the non-profit making tech companies out there in US, which has got impacted much more. So I would say overall, it's a good time to start nibbling and look for good opportunities with a 3 to 5 years view is what I would say.
We are now going through a cycle of earnings downgrade, right? If we are going, can you hear me?
Yeah, I can.
All okay, volume? I hope the mute button is not on.
No, it's all okay.
Okay, great. Now that you can hear me and we can also hear you, my question is that we are going through a cycle of earnings downgrade. And in earnings downgrade, typically, A, P expansion will not happen, and B, the market is unlikely to give you a big pleasant surprise. So how much of this earnings downgrade cycle is something which is already baked in?
So I would say that at least this quarter we are not seeing results actually pointing towards downgrade. Maybe first quarter you will see slight more impact of the increased raw material prices, some bit of more margin pressure, and maybe there is talks of down trading which is taking place in consumer category as such. So some bit of demand may be getting hurt, and there could be some effect of that on the earnings starting next quarter. But I would say that we are on a journey of reasonable growth as an economy, and while we are going through a lot of imbalances, as I may call, from all these supply side pressures and all. These could unwind very quickly as well, just if some of the global macros start turning around. Now if we look at the global retailers results, most of them have actually stored much higher inventories as far as when we look at the number of days inventories are concerned, which means that this can actually in a way also lead to the inflation fear actually lasting much shorter, because the demand is also now turning adverse. So I would say that some of the global macros, as they turn more favorable, things can turn quickly, and hence one should think of the next 3 to 5 years picture where the growth looks okay. Maybe the downgrade season, if any, could be more temporary, 1 or 2 quarters, but beyond that, I think the outlook should improve.
Uh, when you say you like IT, would it be a good idea to go for a sector where you know that the headline movement is not with you? Now we can argue about, okay, Indian IT companies have got nothing in common if you compare them with Nasdaq related companies, but the bottom line is that when money is moving out of IT, I'm sure Indian IT stocks also will be affected.
So I think that, yeah, you're right, Nikunj. I think that's to do more with the headline and narrative rather than the fundamentals. Fundamentally, I think the companies have only guided for a very strong growth for FY23. Some of the global, trends today, talk of recession and all could hurt the sentiment some bit. But I see fundamentally that these companies are generally looking okay in terms of their business. The rupee depreciation should also benefit these companies. So I think once people look beyond these narratives and start looking at the core fundamentals, the value definitely will emerge as far as the sector is concerned. So from that viewpoint, I would say that one needs to look beyond the current negatives which are flowing around, and I think look at the core fundamentals which are sort of on a improving trend.
Sure. Vinit, given that your forte is made in small caps, so let's probe a little bit more and dig deeper there. Just wanted to understand that at a time like this, when, the market itself is looking so iffy, how much exposure to mid and small caps? Is this the, right decline to buy into those names? And is it really the time to be actually market cap agnostic? Should you really be distinguishing between large, mid, and small caps right now?
I have actually, personally, I have, had a, with a long-term view, I've always had a positive bias towards the mid and small cap, because generally these companies tend to grow at a pace higher than the large cap because of the sheer size. And through time, as the growth actually is taken into consideration, the outlook for the mid and small cap turns out to be better. As the long-term price trend tends to catch up or follow the growth metrics. So my skew has been more towards mid and small cap generally, and hence the advice to the investors is, first have a long-term view. Don't look at the short-term volatility. It can be more volatile because these are small market cap segment. But on a long-term curve, I think the volatility reduces and the return profile actually improves. So that's number one. Number two, in terms of sector agnostic, in terms of market cap agnostic, I would rather prefer that strategy where one looks at the pure fundamentals of companies which are large leading companies, even mid-sized leading companies, and they have the key metrics, which basically is the competitive advantage which the company enjoys, the ROC, the cash flows. If you have these factors present in companies, I think it is better to own high quality good companies across the market cap range, and just be patient with those investments, because the external environment can cause volatility, but the core fundamentals will eventually catch up in terms of the outcome.
Okay, so Vinit, let's get a little bit more specific than that. What within mid and small caps are you recommending right now?
Okay, so I think in terms of our own exposure, we have, within the small cap space, we have a decent amount of exposure. I would say large amount of exposure to consumer-oriented businesses. And these may be very small segment. These may be, kitchenware, footwear, type of businesses, the theater businesses. So I would say that you have a lot of opportunities which are available to expose yourself into some of these names, because we believe long term the consumption trends are going to be positive for India, and with that in mind, good brands, high quality businesses, good management which are available within these are something which we are highly exposed to. Next, comes the auto angst as such. I have been sort of talking about the cyclical recovery in auto for a while. It's not happened, it's got delayed, but my sense is that auto has been in a very bad cycle, and once the recovery starts picking up, it could be a very smart recovery over the 1 or 2 years, because of the, let's say, 4 years of decline as far as the auto sector is concerned. Beyond that, I think one could look at specialty chemicals. Agri is a large sector. There are no large cap companies within the agri sector. There are good small caps and mid cap companies, good brands there. One can also sort of focus on those, and with a slightly longer term view, I'm also optimistic on the healthcare sector overall, because I feel that healthcare demand will continue to grow, and these companies, they have the wherewithal to keep growing at 15-20% over a long period of time. So I think these are a few segments where one should sort of look at with a long-term view.
Good morning. So when you say you're still bullish on healthcare, the long-term story is intact. We're seeing stocks like, for example, Dr. Lal Path Lab or Metropolis make new 52-week lows. You're talking about diagnostic stocks, which could now provide a good entry point, hospital stocks.
Yeah, I think across the value chain, starting from the pharmaceutical companies, some of these diagnostic companies as well. These diagnostic companies may see some bit of the earnings slowdown going forward, given the high base which they have got over the last 2 years. But my sense is that these are again good long-term stories to sort of focus on.
Okay. So the sense I also got from you was that you remain overweight on banks. Within that, private sector banks versus public sector banks, what are you preferring?
Surely, I think we have a preference for the private sector banks, and I think clearly, if we look at the results which are getting announced by these private sector pack, it is very clearly showing improvements in terms of the asset quality. I mean, those trends are really visible out there, and this is as per our expectations as well, that the asset quality sort of improves for these banks, which is happening. It is now just about the growth, which is the as we see expansion in the economic growth taking place, we'll have the credit growth also improve for these banks, and that should drive the profitability. So if we actually look at the overall profit pool of the Nifty companies, I think the good amount of improvement in the profit pool is going to be due to the banking sector as such, the private sector bank. So I would say that the next 2-3 years, maybe it would be a good time to sort of own private sector banks. They're getting liquidated by the foreign investors, which is where we've seen the valuations getting let's say derated some bit in the past, and hence it provides a good entry point as well. Fundamentally, I think the outlook has only improved for most of the private sector banks.
Vinit, let me draw a slightly scary scenario, which is that demand which was high gets crushed. If American consumer is slowing down, that will start impacting exports, manufacturing and other sectors. And if energy prices remain stubborn, which they are, crude is still above $110, $111, it actually will have a impact on the macros. So what happens in that kind of a scenario where world slows down, energy prices remains high and macro remains under pressure?
Yeah, I mean, in terms of probabilities, I mean, there are wide probabilities, and the external environment can remain stubborn for a period longer than what we anticipate. But my sense is that, when we talk of these price points on commodities, let's understand that, linked to these price points, it has led to inflation, which is now causing demand scare. So if we look at as you mentioned, the US companies, they are talking of slowdown, which is hurting them now, which actually means that these price points are not sustainable, and these are not caused due to the high growth in the demand. These are more because of supply chain bottlenecks. So I would say that when we think of the a normalized set of a setup, I think these to me are unsustainable level of commodity prices, and they need to correct. And these are not also backed by fundamentals. Back in India, we are also not talking of a very hyper type of a growth. We are in a soft growth phase, and maybe a quarter or two we may also see some bit of impact on the demand. But I think the longer term picture remains good. Once the commodities start sort of correcting, it can be a very quick correction which could take place there, because as I said, it's not supported by very strong demand. And hence I think the normalized picture to paint it would be that we look beyond these factors, look beyond these events. It may get stretched by a quarter or so, but I think the good idea would be to think with a 3 to 5 years view. And from that perspective, once the valuation comes in a palatable zone, that's where the investors need to react. I think when the first wave of pandemic actually had hit, the markets had corrected, and what was actually only in favor was the valuations. It was not known when we'll come out of this mess and how it is going to impact people around. But I think we've come out of that. So most events they come and go, but I think what finally gets respected is the valuations and the core fundamentals.
Making this point again and again that if you look at when markets are bottomed out, whether it is pandemic or 2008, they bottomed out at the peak of crisis, and the valuations were so attractive. But Vinit Samir Arora earlier this week made a very interesting point. He said there are two factors why markets bottom out. One, valuations have to become attractive. So they are good, they are reasonable, but they are not exactly cheap like the previous instances. And then the second proposition has to be that central bankers have to work with you. So that is how we came out of the COVID fall or the 2008 fall. It was central bankers who came out and supported the economy with liquidity. Now they are against you. So that is the biggest limiting factor for markets to bottom out. Where is that support going to come from?
No, it's a very valid point which you make. So as I said, I think the next 6 months or so, a lot of uncertainties are there. It's very difficult to call out at what levels will bottom out. I'm saying that there is good margin of safety which has started emerging in few sectors when we look at the valuation. So I think from that standpoint, it's good. So first, take a 3 to 5 years view and not really get bogged down that I need to wait for the bottom to emerge and then start buying. I think it's the good way to look at would be that once you start finding the valuations palatable, you start taking entry there into those companies or businesses which you like to own, and keep building your position. So I think it's a gradual build-up is what we would also recommend, because you're right. I mean, it's very difficult to call out at what point will we hit the bottom, at what point will the crisis be at a peak, or before that we turn around or we make a U-turn. Who knows? I mean, these are very uncertain times. But only thing which I would like to mention here is that most of the bad news which we are talking of is it's a known problem. When the markets actually panic is more from the unknown factors. Maybe you have a very severe demand scare which may hit you, or the recession is much more severe than what we are seeing today. I mean, those could be the events which can cause more panic. Or, in fact, to me, Nikunj, the biggest factor would be the velocity of money, because so much of money has come and changed the asset class. If some large fund or a institution has to unwind its position for some reasons, because we are seeing the private markets actually getting constrained. I mean, those can cause some bit of panic and can lead to volatile outcomes. But beyond that, I think most of the issues we are talking about is fairly known, and incrementally how much can they more hurt is what I'm trying to think about.
Okay, Vinit, always good to have you on the show. Thank you so much for taking the time out and sharing your thoughts with us on the markets and more.